Hi, this is Jessica Dunn, and we're going to discuss risk and return. So, what are returns? Returns are the financial results of an investment. So, what sort of yield did you earn? The returns can be historical or prospective, so you can look at what you have earned in the past or what you may earn in the future. And they can be expressed in either dollars or percent. So measuring returns in dollars is easy, but there are two major problems. First, you would need to know the size of the initial investment to determine if it was a good return. So a $100 return on a $1,000 investment is good, but a $100 return on a $10,000 investment isn't so good. You also need to know the timing of the payment. $100 return on a $1,000 investment the following year is good, but earning $100 on that $1,000 investment in 20 years is not so good. So let's calculate both a dollar and percentage return for this example. We have an investment that costs us $1,000 and is sold 1 year later for $1,100. So the dollar return would be the dollars received minus the dollars invested. So we have a $100 total return. In percentage terms, we would need to take the dollar of the return, so this $100 that we just calculated, and divide it by the initial investment of 1,000. So that would be a 10% return. Typically, investment returns aren't known with certainty. So risk refers to the chance that some unfavorable event will occur. No investment should be undertaken unless the expected rate of return is high enough to compensate for any perceived risk. But investment risk is related to the probability of earning a return less than you expect. The greater the chance of a return below the expected return, the greater the risk. So let's look at a probability distribution. So here we're looking at the chance that we will earn a specific return. So to look at this, we're looking at a probability distribution. And so with the probability distribution, the tighter or the more peaked the distribution, the more likely it is that the actual outcome will be close to the expected outcome. So it's expected that the actual return will be similar to what is expected. So the tighter the probability distribution, the less the risk. So, and that's because the majority, if we're looking at the red line, the tight distribution, see it's very steep, it's very tight. It's showing us that there's not a lot of opportunity to earn something way out here. It's not a very good chance that we're going to earn, 45% or a negative 15% because there's not much chance of that happening. There's not much area below the probability distribution. But if we're looking at the green line, the flatter of the two lines, the more dispersed distribution, we see that these tails are very, very thick. So that means that there's a large chance that we're going to earn something in one extreme or the other. Either we're going to do really well or really poorly. The expected return is the center of the distribution. So with both of these examples, we expect to earn 15%. And with the red line stock A, we're much more likely to earn that 15% because the distribution is very close to that 15% observation. So there's not a whole lot of observations in the tails. With stock B, the green line, the expected return is still 15%, but there's a large chance that we're going to earn something other than 15% because these tails here are very, very thick. So let's consider the following investment alternatives. So here we have different states of the economy. So we have economic boom, above average, average, below average, and a bust. And with each of them, we have the chance that that will occur. So there's a 10% probability that we'll have a bust. a 20% probability that we're going to be below average. And we continue that through. The one thing to be noted of is that these do have to sum to 100. So we do have to look at all of the possible outcomes. So here we have different investment returns that we expect to be earned in different states of the economy. So with the Treasury bill, we expect to earn 8% regardless of what the economy does. It will always earn 8%. It's the riskless asset. Alta Industries, we expect in an economic bust that will have a negative 22% return, but in a boom we'll have a 50% return. So it moves with the economy. It's positively correlated with the economy. This is the typical situation. Repo, on the other hand, moves counter to the economy. So it's negatively correlated to the economy. In a bust, repo is doing really well. In a boom, it's doing really poorly. This is not something that you find normally. It's hard to find stocks that are negatively correlated to the economy. American Foam here, their returns are all over the place. We have a positive 10% and a bust, below average, a negative 10%. They're just all over the place. And MP here, we see that their returns are also consistent with the economy. They're a bit more condensed than Alta, though. We see that their minimum return is a negative 13%, while their maximum is 43 compared to Alta, who's 50 and negative 22. So let's look at this. Let's calculate expected return. So expected return is equal to the summation of the probability times the return in that state of the economy. So let's calculate the expected return for Alta. The expected return can also be written as E open parentheses R, expected return. Those are used interchangeably. So we need to take the return times the probability and sum them up for all states of the economy. So in a bust, we expect Alta to have a negative 22% return. And we multiply that by the probability of a bust, which is 10%. To that, we add the return in below average, which is a negative 2%, and multiply that by the 20% chance that this will occur. Then we move on to average. In an average economy, we expect to earn 20%, and there's a 40% chance of occurrence. We move on to above average, which we expect a 35% return with a 20% probability. And finally, we move on to boom with a 50% return and a 10% chance that that is observed. So we multiply each of these and add them up. On a graphing calculator, this is very simple. On a financial calculator, you're going to have to multiply each of these individually, write them down, and then add them up. And we get 17.4%. So we can do that for every single one of our different companies. And we see that Alta has the highest return. But is it the best? That depends. It depends on how risky that investment is. So Alta had a return of 17.4%. The market had 15%. American Foam had 13.8%. The Treasury bill had 8%, and Repo Min had 1.7%. One way to look at risk is to look at the standard deviation. So standard deviation is equal to the square root of the variance, or the square root of the summation of the observed return minus the expected return squared times the probability of occurrence. So let's calculate the standard deviation for Alta. So we had said that the standard deviation is equal to the square root of the observed return minus the expected return squared times the probability. And it was the summation of those. So let's go ahead and calculate. And I'm going to draw my square root sign at the end because I don't know how big to make it. So our observed return in a bust state of the economy was a negative 22%. We subtract from that our expected return, and we already calculated our expected return for Alta, and it was 17.4%. So 17.4. Square the difference and multiply that by 10%. Then we move on to below average. In the below average economy, we expect to see a negative 2% return. Subtract from that our expected return of 17.4%, square the difference, and multiply it by the 20% chance that we see that. Add to it our average. So in the average state of the economy, we expect to earn 20%. Subtract from that our expected return of 17.4%, square the difference, and multiply that by 40% chance. So add to that the above average. In the above average economy, we think that we'll earn 35%. Subtract from that our expected return of 17.4%, square the difference, and multiply by the observed chance of 20%. Add to that the boom economy, 50% return, minus a 17.4% expected return, squared, and multiply it by the 10% chance of a boom. And take the square root of the whole thing. So now with the financial calculator, you're going to have to do everything in the parentheses first. So you'll have to do negative 22% minus the 17.4% squared, multiply that by 10%, write it down, and do each one of these lines individually and then add them up at the end. And you will get a 20% standard deviation. And don't forget to take the square root at the end. So if we were to calculate the standard deviations for all of our different investment alternatives, we would see that the Treasury bill has no standard deviation. There's no risk there. Alta has the highest risk of 20% standard deviation. Repo is 13.4, American Foam is 18.8, and the market has a standard deviation of 15.3%. So standard deviation measures the standalone risk of an investment. The larger the standard deviation, the higher the probability that the returns will be different from what is expected. So here, if we combine our expected return and our standard deviation, we see that yes, Alta has the highest return, but it also has the highest risk. So it makes this question of what to invest in a bit more confusing. So it's no longer just ranking expected returns and choosing the highest expected return. Now we're also factoring in this risk, and our brains aren't very good at making multiple comparisons. That's the reason why we get so confused when we go to Walmart and we see 3,000 different kinds of spaghetti sauce. We're not very good at making comparisons. So we like to use a single measure called the coefficient of variation. It shows us the risk per unit of return. So if we have to choose between two different investments and one has a higher expected return and the other has the lower standard deviation, it's best to use something like the coefficient of variation because it puts it on an even playing field. So now we can just compare one single number. So here, for example, let's look at Alta. Let's calculate the coefficient of variation. Remember, the coefficient of variation is the standard deviation divided by the expected return. So for Alta, the risk was 20%, and the expected return is 17.4%. And so that gives us a coefficient variation of 1.1. So with coefficient of variation, remember that it's measuring the risk per unit of return. And so we're looking for a lower standard deviation because the lower the ratio of standard deviation to the expected return, the better the risk-return trade-off. So we're looking for the lowest coefficient of variation possible. So the market, so this would be like the index, like an S&P 500 index or S&P 1500, it's going to be a large representation of the market. We take our risk, 15.3%, divide that by our expected return of 15, and we get 1. American Foam has a risk of 18.8% and an expected return of 13.8%. So it gives us 1.4. Treasury bills, 0 divided by 8, 0. And for repo men, we have risk of 13.4. Divide that by our 1.7% expected return, and that's 7.9. So if we were to choose an individual asset rather than the market, then Alta looks really good. But again, the market does have a lower coefficient of variation. So here's our calculations again, in case you need to refer back to that. Risk aversion is also important. So most people, most of the time, are risk averse. We're not always risk averse, otherwise places like Las Vegas wouldn't exist. We wouldn't have the lottery. But most of us are risk averse most of the time. And what I mean by that is with your real money, with your serious money, you're going to be very risk averse with that. If it's your money that you're going to use to pay rent or buy your groceries, you're not going to gamble that money away. But extra money that you have, you might be more risk tolerant with that money. So let's look at an example here. We have 2 investment alternatives. We have $1 million, and we can either choose to invest in Treasury securities that has a constant 5% return with no variation, or we can invest in Genetic Advances Incorporated. If successful, the stock will increase in price to 2.1 million. So there's a 50% chance of probability that it increases to 2.1 million, and a 50% chance that it will be worth 0. Both investments have an expected return of 5%. So what do you choose? If you choose the less risky investment, then you are risk averse. If you choose the Treasury securities, you're risk averse. And most of us are risk averse with our serious money. So what does this mean? If everything else is held constant, the higher the risk, the lower its price, and the higher its return. Riskier securities have to have higher expected returns than less risky securities to attract investors.